Now, let me share with you that the moment you have all been waiting for the official coronation of Lois as Commodore is not right now, it's tomorrow. But we're delighted to have her with us today on our esteemed panel. So thank you to everybody for joining us to what is really a top-level panel on a sector that is getting tremendous attention right now. And also, I'd like to extend the congratulations to Lars for his new role. Thank you to everybody for joining. Some of you, like Harris and Lars, of course, are, and Stewart, quite late. Anyway, so I will turn it over to Bob and I and Lois are in New York, but the rest of you are around the world. Randy, take over and guide us through, and thank you to everybody for being with us.
Thank you, Nicholas.
Absolutely. Yeah, thanks for the introduction, Nicholas, and thanks for everyone to tune in. So my name is Randy Giveans, head of the Energy Maritime Shipping Equity Research team here at Jefferies. So on today's star-studded panel, we have 5 crude tanker owners ready, willing, and able to talk about one of the most necessary and exciting industries, certainly volatile in the world, crude oil shipping. So on the panel, I'll do a brief introduction. We have Lars Barstad, the CEO, the new CEO of Frontline Management, Mrs. Lois Zabrocky, CEO of International Seaways, Bob Burke, partner and CEO of Ridgebury Tankers, Stewart Andrade, CFO of Teekay Tankers, and Harris Kosmatos, Corporate Development Officer of Tsakos Energy Navigation. So hopefully all of you, make this panel a little easier to moderate than some of the recent presidential debates. So we'll see how this goes. We're going to start with a little bit of background information, get into some of the industry drivers, talk about some of your companies specifically, and then obviously get into some of the hot topics of the day. So with that, let's start. Over the past 12 months, tanker rates have looked like the heart rate of my workouts, right? Extreme highs, extreme lows. So we know what drove the massive highs in the spring with all of the floating storage and just the crazy disconnects of supply and demand in the heat of COVID back in April. But what is kind of driving the current weakness? And more importantly, when will it improve? So looking ahead to maybe the rest of the year into 2021, what are some of the most important demand side catalysts that the market should look for? So Lois, as Commodore in waiting coming up here, I'll ask you to kick things off.
Yeah, thank you very much, Randy. Definitely, yes, we head into the fourth quarter, being at 93 million barrels a day of consumption versus 101, something like that a year ago, with COVID still not really letting hold of its grasp on a lot of the world's population. That's really a part of what's dampening rates. But in addition to that, we've got some destocking going on as OPEC is holding back, and the demand levels have come up somewhat, and now we are in that destocking period, which you particularly see in the United States. So as we move forward, and hopefully we will see a couple of additional million barrels a day of demand here in the fourth quarter seasonally, and refineries coming out of turnaround, margins improving, we'll start to see an alleviation of some of the crude tanker rates.
Okay. And then when it comes to kind of that floating storage, what we saw, obviously the peak of both onshore storage and offshore storage back in the summer, that has certainly trended a little bit lower, but then you start to see a widening of that Brent forward curve spread. So Lars, can you speak on that a little bit in terms of what you're seeing in regards to storage, both onshore and in floating storage?
Well, I tend to kind of primarily focus on the floating one. Kind of what we saw this cycle was obviously a buildup in commercial floating storage type carry trade, but we also, or what we didn't notice kind of as quickly potentially, was the fact that north of China ended up kind of with quite a lot of oil on the water. And a combination of potential infrastructure challenges, delays kind of related to other matters, but also storage of crude. And I think actually in the latter part of this cycle, we are drawing now. We are seeing vessels that have been engaged on storage being released. Ships are not being extended, and so forth. So we are drawing, but I think kind of the most sticky part of this are those vessels that are kind of being delayed for one reason or another in North China.
Sure. And then when it comes to kind of rates, as I mentioned at the beginning, we've seen some wild swings here in rates. Now, current broker reports are in our view misleading, but hopefully you can kind of give some color on that. We'll start with you, Stewart. Right, broker reports are showing VLCCs at maybe 15,000 a day, Suezmaxes below 5,000 a day, Aframax rates below 3,000 a day. Are those rates you're actually fixing, below OPEX, or kind of can you quantify some of your current rates and why maybe there is a disconnect between what you're earning and what the brokers are reporting?
Yeah, so fortunately, the rates that we're achieving are higher than the broker reports. The brokers look at a simple round trip voyage, and in particular on Aframaxes and Suezmaxes, there's triangulation that goes on. We get our utilization well above 50%, and that certainly contributes to higher rates. We've also got a lot of vessels that end up on demurrage with delays and that sort of thing, and demurrage rates are typically much higher than the $3,000 to $5,000 that you're mentioning for Aframaxes and Suezmaxes. So, overall, I would say definitely in the teens, probably in terms of actual returns. But it's a voyage by voyage thing, and there's a lot of volatility and it moves around. So where that number is 7 days from now might be a little bit different than where it is today. But typically in a weak tanker market, yeah, we do outperform where the brokers put the market, and conversely in a really high tanker market, as they report sort of the top fixtures, you don't quite reach those levels either.
Sure. Yeah, and that was kind of my explanation to some clients, saying, yeah, in April, nobody was earning 250,000 a day, but in September, no one was earning $2,500 a day, right? So somewhere in between. Would other owners kind of corroborate on that, chartering well above OPEX at these levels?
I wouldn't be as bold to say, well, above OPEX, yes, for sure. But we're not, it's kind of over a fleet, you balance it out. But there are round trips that are being made in this market, in the spot market, that reflect the broker reports, indeed. But you have more options than just doing the indices, to put it that way. So over a fleet, you are still well above OPEX.
Sure.
And Randy, you make it sound as if we're in the doldrums, that tankers are in the beginning of a big crisis. And nothing like that. These rates that we see reported, as Stewart very rightly mentioned, are for a particular voyage for a specific period of time. So we're talking about spot cargoes, spot trips that last for a few days or a week or two. They are indicative of the trend. Yes, the market today is going through the soft, if you like, the soft patch of the year. We are at the seasonal lows. However, we do expect, and we do believe, and we do see much firmer rates than those reported. So yes, the indication is that the market has softened from the highs of March and April, but owners do achieve much healthier rates, especially those ones that have a strategy like ourselves to fix the vessels on a longer term contract basis. However, if an owner is more spot oriented, obviously, through the period that a particular vessel will play the spot market, you're going to have some low rates and some high rates, and hopefully some very high rates. And we do expect, and we do kind of see that as we move closer into the winter period, eventually the fundamentals, the very healthy fundamentals in the tanker market, will gradually begin to translate into much healthier rates both in spot and eventually in longer term contracts. So all in all, we're not worried at all, and we look forward to passing this soft period and entering the seasonally high period. So overall, we are very optimistic that the market will eventually will turn into our favor.
I disagree a bit. The market will eventually turn into our favor. It always does. And the best cure for low prices is low prices, as they say. But I think there's a structural problem in the market. I don't think anyone on the screen here today has ever experienced an 8% decline in demand. That seems to be semi-permanent. Fortunately, we're in a business where about 5% of the ships on average each year go away. We know the order book is low, but as I said before we went live, when you're looking for a low order book to save you on the spot market, then you're really grasping for straws. But I think we are down about 8 million barrels a day, and as when people ask me why, I think there's one answer, and that's airplanes. It's like when Dustin Hoffman was in The Graduate, and the guy at the cocktail party said plastics. I think our answer is airplanes, and the barrel per barrel correlation seems very highly correlated to airplane travel, especially long haul travel. And everything I read shows that the cars are back. They'll come back even stronger, so that'll pick up. On the airplane side, you're going to see less kids from the States going to Europe to go abroad, less tour groups, less bopping around the continent for a weekend. All these things, even though they may be safe, I think in the psychology of the consumer is going to be put off the shelf till next year, and then maybe a little bit longer and a little bit longer. It's going to be a lot more pain to see that sector come back, and that's a big driver in our industry.
Yeah,
Robert,
and I agree. Yeah, I would agree with that, and I think there's a number of factors that are weighing on the market right now. Some of them are things that will probably be with us, like airline travel, as Bob said, that will be with us for quite some time. They're going to take a while for those things to work their way out of the system, and we don't know when or how quickly that will occur. And there are things like vessels on floating storage and coming back into the fleet, which are depressing rates, which are probably more of a shorter term phenomenon, probably not as long as it'll take for airline travel to come back. So there are a number of things operating that are affecting rates right now, and different ones will work them through the system in different ways. When the oil markets rebalance and inventories come down, that'll be a great help to us. So as usual, it's a relatively complex situation to work through.
Well,
sorry, Lois, go ahead.
As Bob says, usually have 5% per year of the fleet coming out. But as we know, in 19 and really 20, we haven't seen very many recycling candidates. And when we run the analysis on history, not that it necessarily repeats, but it usually takes at least 6 months of a depressed environment to really start to see vessels start to recycle as owners look at, okay, hey, how much do I have to put into this 15 or 17 and a half or 20-year-old tanker or older than that. So I do think that at the levels that we're at, we should start to see some vessels taken out of the market, which we haven't seen, probably 18 months. 2018, I think, was the big year where we really saw a lot of vessels that were made obsolete. I'm sorry, Harry, go ahead.
No, just to compliment on what all of you said, and perhaps on Bob's point, the structurally, yes, things have changed for the worse due to the COVID obviously implications, and demand has decreased by about 10% from the peaks at the end of 2019. However, what we're seeing now, we're seeing the gradual regaining of those losses. We are probably in the 90s from, the high 80s, low 90s. We're probably in the 93, 94 million barrels today from the peak of 101. So we are gradually seeing those new additional barrels being seen into the maritime sector. And all of us on the panel, and I think it's very important for the audience, especially the investors that are looking into the sector, to think that all of us, all the companies here in the panel, are in shipping for the long haul, for the long term. All of us have been around forever, and I think, fingers crossed, all of us will stay in shipping forever, or at least the companies, not necessarily us. But short, blips that we're seeing today in the market are part and parcel of our industry. So yes, structurally on the oil side, things have taken a turn for the worse. However, structurally on the tanker side, on the physical asset side, things are shaping up to be to make the tanker drivers one of the best probably times since recent memory. I mean, don't forget that despite the $5,000 rates that Randy mentioned, or the $2,500 rates that certain spot routes are producing, still today, to this day, the VLCC, the Suezmax, the Aframaxes have earned historical high rates on average. I mean, we're looking at close to $55,000 year-to-date average for VLs. Something like $35,000 for the Suezmaxes, and again something like 30 to 35 for the Suezmaxes, and somewhere in the low to mid 25s for Aframaxes. These are not bad rates for a VLCC. When you have a break even of $25,000, $26,000, $27,000, your vessel has earned almost double its break even through the period of the global lockdowns and the COVID crisis. So things are not as bad as people look if you take if you widen the scope of your analysis.
Yeah, so 2020 is certainly going to go down as a great year, right? And obviously the fourth quarter, there are some short-term headwinds coming into the sector. And we'll get to supply and the positives of that outlook in a second. But before we do, just by a show of hands, we don't need any words, looking at the one-year time charter market, the market is saying over the next year, rates will average $27,000, $28,000 a day. Does anyone or who here expects the 2021, let's just call it, average VLCC rate to be above $28,000 a day?
To be above?
Yep. 1, 2, 2.5. What about 35,000 a day? Anybody say 35,000, 2021 average? Okay, so not that high. What about Suezmaxes? One-year time charter is 17, 18,000 a day. Above that for 2021? Across the board, 25,000 a day. Anybody say Suezmaxes will average 25? All right, so you're looking at, okay, we got one. Okay, we got two. All right, I'm not going to ask any higher.
You, Lars.
Well, yeah, exactly. We might have some deal flow. All right, well, so not terrible year. Obviously not replicating 2020, but still pretty decent 21. Now, turning to the order book, I think that was mentioned briefly here, and as part of the silver lining, maybe, to COVID, there just hasn't been much ordering at all. Basically, the order book's down to a 23-year low, something like this. So I guess, Harry, we'll start with you. Tsakos recently ordered some new buildings. So I guess, what are your thoughts on ordering, where the order book is today, where it's going? And then I'll switch over to Bob. What are your thoughts on scrapping? So Harris, start.
Yep. Well, as you know, we have built the company from 3 vessels to close to 70 vessels today by ordering vessels. Over the last few years, all the orders that we have placed are against long-term contracts, and this remains the strategic philosophy of the company when it comes to ordering. And besides the employment attached, it's very important for us to know that we're going to have the client with us along the way. So it's very important to always contract the vessel with high-end blue chip clientele, and we've been very successful over the life of the company to always be associated with the top-notch charterers. So for us, it's very important. Before we place an order to have a contract attached. We have been very vocal against the speculative ordering, even though today some people may be enticed to to place a speculative order just because of the very low order book today, probably the lowest in 20 years. However, because the company, the way TEN has shaped over the years is to cater to the needs of the big oil majors. And to this effect, we will order any vessel our clients will want. So we will not necessarily make the decision internally, if you like, to go out and order, I don't know, 2 Suezmaxes or 5 VLs or 3 Aframaxes. It all will depend on the needs of our customers. And this is how we have done it in the past. I mean, let me remind you that we have built 9 Aframax vessels for Equinor, the ex-Statoil. It wasn't us deciding that we wanted to expand in Aframaxes. It was Statoil that wanted to build those vessels. So this is how we view growth vis-a-vis new building growth. So that's something that we will continue to see. We are a company always focused on growth, and as long as we get a good, accretive, sticky, solid charters, we have the financial capacity, we have the financial muscle, we have the access to capital to go out and in a modest, responsible way, go out and build the vessels necessary to carry those cargoes.
Okay. Bob, what about scrapping? You have a very average, the industry has a very old average fleet age, a lot of vessels coming up to their 20-year, 22.5-year special surveys, what have you. We can see a scrapping pickup?
I think, first of all, we all talk about how the market's going to look next year. I think, most of these trends or analysts often draw out how long it'll take to recover for demand or for supply, and they tend to right themselves faster than we think. So I think, scrapping's certainly a part of that. We've had older ships, and it's a really interesting dynamic as ships get older, especially the big ships with a lot of steel. You're looking at 2 very volatile markets, the VL market, the freight market, and the scrap market. And the difference between $300 a ton and $500 a ton, we all know is $200. But for people who aren't directly in the VL business, that's 200 times 40,000. It's about an $8 million difference in your scrap price. So what drives the demand for what drives the owners to scrap is the volatility of the scrap price, as well as the volatility in the freight market, and the waypoints along the way for special surveys. So to answer your question, there are issues on the subcontinent with scrapping with COVID, so that's held back a lot of the scrapping activity. Us owners are full of cash, and like anyone else with a pocket full of cash, you tend to be inclined to take another bet if you have the opportunity. So there's been a bit of a resistance to scrapping, even when it may be the natural choice in the more difficult market. So as Lois pointed out, I don't think any of these have been scrapped this year. Maybe one. None? It's either 1 or 0. And last year was a handful. So there is pent up supply of ships that should be scrapped. A lot of the older ships went into storage, and we're waiting for that to unwind, which is a threat to the supply of tankers coming into the market. But I think with rates where they are, a lot of those ships are 18, 19, 20-year-old ships in storage, and as they unwind, they'll probably go right to the scrapyard.
Okay.
The price of scrap is getting healthier, but the expense of scrapping is getting higher because of all the ESG compliance issues, which as responsible owners we have to conform to, above and beyond what maybe someone else might.
All right, and a quick show of hands, expectations for 2021 annual fleet growth below 1%. Anybody think the annual fleet growth below 1% next year? All right, 1 to 3%.
I think, yeah.
So all right, 2%. Anyone expect annual fleet growth to exceed 2% next year?
No.
So a very low hurdle for.
Better not.
Yeah, that's fair.
Yeah.
All right.
And
well,
I think importantly, Randy, that this is just quickly that this is a multi-year story. There's the next year and what's going to happen, and there's the fact that we haven't seen much scrapping. But if you look at the Aframax LR2 fleet, for example, 37% of it is above 15 years old. There was a lot of ordering in the early 2000s. So this is a multi-year story that will underline the tanker market and I believe help create a healthy environment for the next few years. So we've all been fortunate enough to generate a lot of cash flow and have pretty healthy balance sheets. And I think the age of the global fleet and the lack of scrapping recently means that we're going to be in a good position going forward. The exact timing of it and what exactly happens over the next 12 months, I think is, it's, debatable, and there'll be lots of things that will act on that.
Sure.
I think one thing we have
I
of
just-
course is I'm sorry, one quick comment, Lars, is a lack of outside capital that's likely to come into the market. There's a lot of pushback against carbon, a lot of pushback against energy complex in general. The energy stocks are down. The PE groups who raise money for energy are having a hard time. Returns over years, not just in our sector in shipping, but energy in general, have been dismal. So I don't think we can see a huge influx of capital market money or PE money coming in and ordering 10, 20 ships to throw. It's going to be mostly organic, which should in theory drive our returns up. Sorry, Lars.
I just wanted quickly to first of all, in Norway we call it recycling, not scrapping. No, I just want to say that the picture on recycling is maybe a little bit colluded by all the extensions given kind of during the COVID crisis, because obviously you have your 20-year survey, which is normally a hard stop for most, unless you have a storage contract in hand or something like that. And obviously a lot of these vessels that are the 2000 builds that were supposed to go through 20-year kind of service this year have gotten extensions and are on storage and will be released. And that's maybe when we will start to see the numbers.
Got it. All right, Lars, staying with you. Speaking of new build ordering, hopefully no one's looking at that. But if you had to order a new building, do you go conventional oil? Do you go with or without a scrubber? Do you go LNG powered? Do you put a battery on that thing? Like, what are you looking at in terms of new build ordering?
Well, if I had to, well, first of all, it depends a little bit about the vessel class, because there are differences there.
VLCC.
But let's just talk VLCC service, and I think kind of the only viable technology to choose right now would be dual fuel, and there are dual fuel technologies out there now, with a very minimum methane slip. And on the VLCC, you can actually fit LNG tanks on the deck. So I think that's the only viable kind of option to go as it is right now. There will be other technologies and all the other solutions coming on, but that's probably where my money would be if I had to make that decision. But then again, I think this is what is keeping us back from going to the yards and order ships. Is basically, we are in uncharted territory. Both regards to regulations and also there is a technology race out there. What will be the proposal going forward?
Got it. All right. And then we only have about 10 or 15 minutes, but yesterday on the products tanker panel, Bugby's not here to interrupt, so he was very boisterous, and everyone was, of product tankers are... Robert, not you, Robert Bugby.
Bugby was boisterous?
Yeah, seriously. But you also had even Tony Gurney and everybody on that panel was saying products tankers are certainly the best positioned. You're having these refineries closer to the production areas. You're going to have longer haul tonnage for refined products tankers. That is the sector to win. Lois, I'll turn it to you because you operate crude tankers and refined products. So, kind of asking you to pick your favorite child here, but which sector is better positioned? Is it refined products, sure, or is crude arguably better?
I mean, I have said many times, I think that the whole complex holds together very closely. And indeed, for crude carriers, for our market to recover, we also look for refinery margins to improve, right? But even the refined product sector is not one sector in my mind, right? So, if you want to talk about, who has added the most refineries, it is by and far China in the last 2 to 3 years has brought online over 2 million barrels a day of production. When they bring their refineries online, they run them beyond what China's internally consuming, and they export MR cargoes or LR cargoes. So, right there, that's a V move in, and that's a product carrier move out. You do see there's a new refinery coming on in Saudi. I think it's another 400,000 barrels a day. That tends to be very good for LR2s. I bet that's going to make Stewart happy because LR2s and Afras, you can't talk about one without the other. There's 1,100 of them, 300-400 LR2s. They go clean, they go dirty, they go where the money is. So, to me, the MR market is distinct. It's very interregional, right? You've got the U.S. Gulf to Latin, South America market. You've got the Asian market. So I feel like the whole complex holds together. And, you know, overall, the preponderance of our tonnage is on the crude side. That is by design.
You know, here in the States, Randy, as you know, Boston has a big rivalry with New York. Bostonians are always comparing themselves to New York. New York doesn't know Boston exists. And so I'm glad the guys were, you know, all up in arms comparing themselves to us yesterday, but I hadn't, you know, given that a thought. But
that's fair. Boston and New York, neither are playing baseball right now. I think Houston still is, but yes, I digress. That's fair. That's a fair comment. Now, when it looks at ESG, you know, that was kind of where I was alluding to in terms of ordering. What are your companies doing to prepare for ESG? Is that even as hard as you work at ESG, you're carrying crude oil, right? How can a shipping company comply or maybe advertise itself as ESG friendly? Anybody? I know Lois, you've done some ESG financing. With
Absolutely. Yeah, I was going to say, you know, the ESG financing. I mean, you know, most of us here participated in the Global Maritime Forum, which we're just coming off of. You know, the decarbonization efforts are just escalating, and the amount of time that all of us and our technical guys are spending on regulatory developments that IMO is getting out there for the existing fleet, EEXI, in addition to EEDI. It is massive, right? So all of this is coming at us, you know, very quickly, and I think everyone on this panel is taking it very seriously. When looking at OPEC, IEA, BP, Total, all of whom now do a 2050 study, you know, when you look at everything, whether you're OPEC and IEA and you're looking at like 109 million barrels a day in 2030, or you're even if you're BP, who's the most bearish on oil carriage, you're still at 2030, you're still 100 million barrels a day of production. So I think that everybody on the panel is going to have plenty of crude to carry over the next decade and beyond.
Okay, Stewart.
So on ESG, I think, you know, it's a global phenomenon. It's hitting every country, every industry, and just because we ship crude oil doesn't mean that we're not a participant in that. So I think everybody and all industries are moving in a certain direction, and we're certainly moving in that same direction as well. You know, it started with energy efficiency and improving the efficiency of our vessels. All of our ships burn less fuel now than they did 10 or 15 years ago, and that will continue. At Teekay, we've signed on to the UN Global Compact. We think that's an important thing to do. We support those. We support their 10 priorities, and we've had sustainability as one of our core values for many years. So I don't think it's about transporting crude oil and therefore ESG doesn't fit. ESG has to fit for everybody, and it's all about from where the baseline is now and making improvements. And you know, ESG is multifaceted as well, right? There's a lot involved there. So I don't think it's a question of whether it fits. I think it's a necessity, and it's the reality of the world, and that's the way we're moving, and we're all need to be on board and support it.
Okay,
that's my.
I fully agree with the Stewart there, but I just wanted to add that you know, although we do kind of carry cargoes that might not be kind of in favor right now, kind of ESG wise, but we do it in a very efficient way. So kind of the volume we manage to move with kind of relatively little energy, that, you know, people kind of lose that a little bit in the context there. So being it whether if you're a tanker or a box ship owner or whatever you do, it is actually an efficient way of transporting stuff, and you know, the world needs stuff to be transported.
Sure.
Yeah,
and I think go ahead, Bob.
You know, ESG didn't come out of the blue, but it's sort of blown up the past few years, and I think we make, you know, all these efforts to increase fuel efficiency, life cycle efficiency, recycling efficiency, and safety. And the challenge is to do it properly and make it a competitive advantage for each of the companies here, and also to get a better face for the industry as a whole, which is extremely challenging because we never get into the press until there's a problem. They don't mention, for example, Lars, how efficient we are compared to moving stuff by rail car. It doesn't come up. You know, we just come up when times are bad.
No, I think, Ron, it's very important to highlight that, I mean, we're talking about ESG, especially the E part of that acronym, as if it's something new, as if it's an issue that we need to face today and change our kind of course for the future. I mean, don't forget that tanker shipping has been on the forefront of reinventing itself over the last decades. In order to meet the ever-changing needs of environmental regulations. So it's not something new. I mean, shipping tankers, you go back to OPA 90 when the double hull design had to be implemented. All of these changes and from that point onwards have been in order to address the environmental needs at a specific point in time. And I think all of us that they want to have a lasting kind of power, if you like, in tanker shipping, will address any upcoming issues that needs to be addressed concurrently with our charterers. And it's important that shipping and tankers will not be the guinea pigs. All of us, we need to contribute, because in the end of the day, the ships need and the companies need to make a return, and this in return to be in business. We're not, the guinea pig for the world. All of us need to benefit.
Yeah. All right, we got about 5 more minutes. I have 2 more questions. A lot of them are in the Q&A, and I'm going to roll into one kind of deal. So just looking at the industry, this has been a theme for the 10 years that I've been covering the space, consolidation, right? Like there's been some, there hasn't been enough. Right now you have public equities trading at 20, 30, 40, 50% discounts to NAV. You have private owners looking to maybe offload a handful of vessels. You have, I think in the Q&A here, the Shipping Corporation of India apparently is now for sale. The government put that up. So what are your thoughts on consolidation? What's holding the industry back from consolidating? Everyone says, oh, consolidation is good, just not for us, right? Give some color on that. 3 minutes.
I don't think the math works. If you consolidate and you have 5 companies left, they still beat each other's brains out. And it takes a small group of people to buy a ship and outsource the disciplines, the chartering and the technical business. So I think it's not going to raise our rates. That's my 2 cents.
Okay.
I think the industry is too fragmented for any meaningful consolidation to have an impact.
Yes, certainly we are very fragmented, but I do think the amount of R&D and collaboration could potentially lead to M&A, because we're going to have to spend a higher amount of our balance sheets basically innovating going forward.
Yep.
Yeah, I think consolidation will occur. I think it does occur, and I think it will occur when the numbers make sense and there's value to doing it. I think if there was huge value to mass consolidation in the industry, I think you'd see more significant consolidation in the industry. And I think the fact that you don't see a huge amount of it, I think, to my mind, is pretty indicative of the question mark that exists on how much value that brings.
Sure. All right, so we have 2 more minutes. Last question here. Obviously, the last 9 to arguably 12 months, really, were very good, and everyone's cash balances are inflated now. Balance sheets are much improved. So it's no longer a hypothetical question. What would you do with extra cash, right? You have extra cash. So assuming that keeping it on the balance sheet is not allowed, what do you do with it? I want each of you to answer in the 2 minutes we have remaining here. Do you buy shares? Do you buy secondhand vessels? Do you just pay down debt aggressively? Or do you go and order new buildings? So of those 4 options, I know there's a million options. What say you? Lois, start us off.
Yeah, we think that our shares today, where they're trading, represent very good value. And in time during this cycle of this downturn, we will look to refleet.
Okay. Lars?
Well, we historically, we want to kind of pay back our shareholders, basically give them return on their investment. But and that's basically normally what we do. But obviously we want to grow as well, but we are facing the challenges, the technological challenges that we've described before, that it's, going out and ordering an asset that's supposed to live for 20 years with the current regulatory environment and a lot of unknowns going forward. Not on the market. I'm pretty confident on the market. I'm just very confident of the various challenges we need to face kind of with those vessels. You get a bit hesitant to put it that way. So pay down debt, make sure kind of your company is strong, because we could be in an extended period of low markets here, if the world doesn't recover. We're not, by no way out of the woods yet. Just look around in Europe where we're starting to discuss lockdowns again. But first of all, we like to actually, to pay back the investors for their kind of confidence, and then they can reinvest if they want to.
The last three briefly, Stewart.
Very briefly, we've sold about half our ships the past year, so we paid down all our debt. We're going to wait a bit and buy some secondhand tonnage. And I'm going to correct you: there's no such thing as extra cash.
Excess. Stewart, come on in, man.
Yeah, we're going to continue to focus on paying down debt for the short term, and then looking into 2021, we'll just have to see how the market develops and where asset prices are, and make a decision on the best capital allocation for our shareholders next year. But at the moment, we're going to continue to pay down debt. Harris, finish us off.
Okay, so we're trading at huge discounts to NAV, so continuing the share buyback program is a no-brainer. Whatever is left of that, we're going to repay the $50 million of the Series C prep by the end of October. And then we need some money for growth. As I mentioned earlier, we're always on the lookout for opportunities on the new building front with accretive time charters. And of course, have cash to maintain the healthy dividend that we've been paying all along.
Sounds good. All right, I'm getting the hook here. So thanks again. Thanks to all those participants. And Nicholas, our pleasure.
Thanks, Randy.
Thanks,
Randy. Good to see everyone.
Thank you.
Take care.
Thank you.
Bye-bye.
Great panel.